This is Macro Horizons, episode 349, The Supremes, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of November 10th. With the tariff ball now in the court of the Supreme Court, pun intended, there's a long list of hits from the Supremes that could soon prove applicable. The top hits never recorded include, number 1, stop in the name of Dove. Number 2, you can't hurry trade. Number 3, levy child. Number 4, come see about free trade. And of course, number 5, let the goods shine in. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market was offered a number of meaningful economic data points to help guide investors' understanding of the performance of the real economy as the government remained shut down for the time being. The ISM services print came in stronger than expected, with an unanticipated increase in the prices paid component. ADP surprised slightly on the upside, adding 42,000 jobs for the month of October. However, in the context of the broader trend, that doesn't suggest that the employment market is heating up by any means. Now, there is clearly informational value insofar as we haven't seen a material leg lower in ADP, all of which is consistent with the Fed's interpretation of the labor market as being stable at the moment. We continue to have concerns regarding the outlook for the labor market and worry that when the official data is back online, it will reveal an even easier Q4, not an acceleration of employment growth. The lack of government data has led investors to seek alternative measures. The Revelio Labs print of their estimate for payrolls growth in October was negative. It came in at negative 9.1 thousand. When we look at this summer's trend in this particular data set, we can see softness comparable to what was revealed in ADP, as well as the BLS data before it went offline. Specifically, June added 4.2 thousand jobs, July 13,000, August 14.5 thousand, and September 33,000. So the fact that this has shifted into negative territory is somewhat concerning. Similarly, we saw a spike in the Challenger layoffs report. Here in the month of October, there was the largest increase in layoffs for the month of October since 2003. Overall, there are clearly competing different data points that have reinforced the notion of uncertainty at this particular moment in the cycle. One point of clarity that was offered in the week just past came from the Treasury Department via the November refunding statement. Auction sizes will not be increased, and as has been the case in recent statements, Bessent retained the language that Treasury anticipates maintaining nominal coupon and floating note auction sizes for at least the next several quarters. However, the statement went on to say that, looking ahead, Treasury has begun to preliminarily consider future increases to nominal coupon and FRN auction sizes, with a focus on evaluating trends in structural demand and assessing potential costs and risks of various issuance profiles. The market took this as bond bearish, although we'll argue that most investors had already had higher coupon auction sizes on the radar as an inevitability for 2026 or 2027. If anything, we're interpreting the fact that Bessent has kicked this particular can into fiscal year 2027 as a net positive. Simply stated, we'll have another year at these auction sizes.
Well, it would have usually been a very exciting podcast because we would be talking about the jobs report. But we didn't even have to wait till Friday to get the jobs report. This week, it just so happened to be ADP. that came in firmly above consensus, and combined with the upside surprise we saw in ISM services that showed the highest prices paid print since October 2022, the marquee data events of the week, which this week just so happened to take place on Wednesday, were enough to trigger an impressive round of bearishness in treasuries that got 10-year yields back closer to, although certainly not yet within striking distance of 425, as the economic data that we have received has painted a slightly less dire picture on the employment landscape and added some credence to the argument that there are still upside risks facing the inflation outlook. And while we still think the Fed is going to cut again next month, following Powell's press conference and this week's round of data, it's no longer as clear-cut as it was just a few weeks ago, and with the market now pricing around 15 or 16 basis points of a cut in December, yields have repriced to reflect that uncertainty.
And to be fair, this was Powell's objective. Powell wanted to make sure that the market didn't fully price in a rate cut or more, and thereby limit the FOMC's flexibility come the 10th of December. Now, as the government shutdown remains in place, although there are some rumblings that it could be resolved over the weekend or in the week ahead, the reality is that we do not have the economic data that we would typically have to help investors and the Fed navigate this point in the cycle, and if anything, recent developments have only extended the period of uncertainty. On Wednesday, the Supreme Court heard the case for Trump's tariffs using the International Emergency Economic Powers Act, and, to put it mildly, the takeaway was skepticism at best. Now, presumably, it will still be several weeks before the Supreme Court issues a final ruling, but the conversation has already turned to what happens if the Supreme Court rules against Trump. One issue is that there's more than $50 billion worth of tariff revenue that has already been collected. Does that get returned? Does it get partially returned to certain parties? And perhaps more importantly, how credible will investors believe that the administration's other workarounds for implementing tariffs will ultimately prove? That question is fundamental in determining the market's response to the Supreme Court ruling. In the event that the market simply views it as a hurdle to the eventual implementation of tariffs using a different legal structure, then it should be marginally bearish, as we saw on Wednesday. However, if the ruling materially changes sentiment toward the power of the executive branch, then we might see either greater pushback from our major trading partners or a softening of the administration's approach. In either of those two scenarios, we would expect a lessening of any forward inflationary pressures associated with the risk of even higher tariffs. Now, a drop in the effective tariff rate doesn't mean that all of the tariffs are going away. There's certainly plenty of them that will remain in place regardless of the Supreme Court's ruling. It's also worth noting that there has been a material shift in the framing of reflationary pressures since the peak tariff pass-through risk immediately following Liberation Day. What the CPI data between May and September revealed was the conspicuous absence of a 100% pass-through of higher tariffs to the end user. Instead, what we have seen is a relatively benign inflation environment. Sure, there were a few months in which core goods ex autos appeared to be accelerating to a new plateau, but that pace has clearly moderated, suggesting that any eventual tariff pass-through won't rebase forward inflation expectations to a higher plateau. And frankly, that was always the major inflation risk associated with the trade war. The uncertainty created by the trade war, however, as we have seen, has translated into a stalling out of employment growth. And the question now becomes, will we reaccelerate into the end of the year, or will hiring paralysis lead to a net decline in labor market conditions?
And to your point, Ian, regardless of what comes out of the Supreme Court's decision, there are several dueling impulses to consider as for what it means for the path of treasuries. On the one hand, inflationary risks, whatever form they ultimately take, will obviously be moderated by fewer tariffs, but on the flip side, and arguably contributing to the price action we saw this week, is the implied boost in the growth outlook, and relatedly to what you're talking about, optimism on the corporate side that maybe taxes won't be quite so onerous and maybe hiring freezes or downsizing workforcing plans can be suspended, considering that the most severe tariffs aren't legally allowed to be implemented. And so from that perspective, as we think about what that means for monetary policy, especially after 50 basis points in rate cuts over the past 2 months, maybe the level of monetary policy restriction has already been dialed back enough to be suitable for that environment if firms are feeling better enough about the outlook that the headwinds facing the labor market are no longer as pronounced. And thirdly, maybe most importantly, is that uncertainty aspect. Because if we've learned anything about the current administration, it's that it is certainly not shy about using novel approaches to get its policies passed. So hypothetically, even if the Supreme Court rules against reciprocal tariffs, that's not going to mean that all of a sudden there is a clear path forward for U.S. trade policy. Instead, there will likely be a renewed period of uncertainty as Trump tries to get around whatever the Supreme Court decides and implement tariffs in another fashion. And it's that uncertainty aspect, regardless of what ultimately comes to pass in terms of tariffs, that leaves us anticipating that caution is probably the more likely approach that firms are going to take as it relates to hiring, as opposed to a renewed expansionary bias.
And another development that occurred in the week just past was we got the refunding statement. Within the refunding details, we saw no change to auction sizes, which wasn't a surprise. No one was expecting auction sizes to increase. However, the refunding statement did retain the several quarters language, implying that for the foreseeable future, auction sizes will not be increased. The statement did introduce a new paragraph that effectively said, looking forward, the Treasury Department will at some point need to increase auction sizes. The TBAC recommendation targeted fiscal year 2027, which is very consistent with our operating assumption that the first time coupon auction sizes will be increased at the earliest is November 2026, i.e. the beginning of fiscal year 2027. Within the details of the TBAC statement, we see that the Borrowing Advisory Committee suggests favoring the belly of the curve and potentially reducing issuance in bills and longer-dated treasuries. This is generally viewed as the least disruptive way to increase auction sizes, and frankly, assuming that the Fed delivers at least a couple more rate cuts over the course of the next several meetings, by the time Besant needs to increase auction sizes, the front end of the rate complex, at least, will be presumably biased a bit lower. After all, 2, and to a lesser extent, 5-year yields tend to track very closely with near and medium-term monetary policy expectations.
And one of the more interesting pieces of information within the refunding statement was as it related to how the Office of Debt Management is viewing the current size of the bill market. We had sort of been operating under the assumption that there was still no shortage of capacity for bills to continue growing as a share of overall marketable debt outstanding, but instead what we saw in this week's release was some mild concern that bills were pushing up against the frontier of what was being viewed as acceptable from the Treasury market's perspective. That obviously was reflective of TBAC's recommendation around the fact that bills should probably stay the same, so should the long end, and issuance going forward should be concentrated around the belly of the curve. But this acknowledgement gets at one of the other factors that's surely playing into the Fed and Treasury Department's calculus around the state of the front end of the curve. Yes, following month end, we've seen repo become relatively more behaved, and for the time being, the Fed has held off either announcing TOMOs or reserve management purchases. Instead, the bill buying that we're going to see is going to be limited to simply reinvesting MBS portfolio runoff. The current state of reserves and the proximity from the abundant to ample transition line in the sand means that the size of the bill market has probably reached critical mass. And while ultimately we do expect that the Fed will announce temporary open market operations, if only to serve as a reassurance to the market over year-end, and eventually, maybe sometime in the early part of next year, we do expect that reserve management purchases will resume. Clearly, these same concerns have made it on the Treasury Department's radar as well, and that means that there's going to be a bit more caution in terms of growing bill supply moving forward. We continue to keep an eye on the money market as the Fed's shadow third mandate, and while for the time being, the standing repo facility and MBS reinvestment into bills has been enough to bring concern back from the peak levels we were discussing last week before the end of the month, until reserves start to definitively grow again, there promises to be an underlying anxiety that's going to continue to linger in the background for both the Fed and the Treasury Department.
If nothing else, it's very clear that when Besant and Powell go out to dinner, Powell picks up the bills. In the week ahead, the Veterans Day holiday means that the market will be closed on Tuesday, November 11th, but open on Monday the 10th. And on the 10th, we see the $58 billion 3-year note auction in the afternoon, followed by Wednesday's $42 billion 10-year refunding and Thursday's $25 billion long bond auction. The focus on supply in this current environment is somewhat intuitive given the absence of economic data. Even in the event that the government reopens over the weekend or early next week, we're still unlikely to get any meaningful economic data until the week of the 17th, if not longer. While there have been some rumblings about potentially reopening the government coming from Washington, the reality is that this will go down in the record books as the longest government shutdown in history, at least until next time. Translating this all into a trading bias for U.S. rates, we, as a theme, remain generally constructive on treasuries. We expect 10-year yields will end 2025 at 3.85, and the front end of the curve will largely be a function of the Fed's decision whether or not to cut rates at the December 10th meeting. All else being equal, we think that the Fed would prefer to continue the process of normalization with another 25 basis point cut, especially in the event that the economic data remains conspicuously absent. The Supreme Court's initial skepticism regarding the legality of Trump's tariffs has introduced another potential risk and focus of the ongoing angst and uncertainty. While there's no specific timeline for the Supreme Court to issue a ruling, the assumption is that the process will take at least several weeks, if not be held over until the new year. The tradability of a decision to overturn Trump's tariffs is a wild card. It seems to have initially been bond bearish, but at the end of the day, if it relieves inflationary pressures, we suspect that it should compress longer-dated break-evens and serve as an offset to the potential for higher rates. Returning to supply considerations, we do think that the refunding will warrant a concession, either outright or on the curve. In the event that it is in outright terms for 10-year yields, it's difficult to envision going beyond 4.20, given the buying interest that emerged when 10-year yields pressed up against 4.16. But nonetheless, a modest concession, given all of the cross-currents in the market at the moment, certainly seems warranted and, as is so often the case, would likely contribute to a solid takedown in 10s. After all, auctions bring out buyers. The long bond faces different challenges, and the duration-heavy sector has been under scrutiny recently, although with 30-year yields now comfortably below 5%, we expect that all else being equal, the auction process will be relatively smooth. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the baristas apparently plan to strike on Red Cup Day, we find solace in the fact that at least it isn't Red Solo Cup Day. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.